I'm going to show you how to analyze and calculate the price to earnings ratio, which is one of the most important ratios used to analyze stock value. This ratio tells us how much above the company's earnings are we paying to own a share of the stock. Another way to think about it is if an online business has a net income of $100,000 per year after all expenses and taxes, how much money would you be willing to buy the company for? Put your number in the comment section below. If you're willing to buy the company for $300,000, then you're willing to pay 3 times the earnings to own the company. And assuming there is no growth and the company continues to have a net income of $100,000 a year, then you'll get your entire invested return back in 3 years. The same concept applies to price to earnings ratio for evaluating stocks. If a stock has a PE ratio of 20, then it means for every $1 in earnings that business generates, people are willing to pay 20 times that amount to own a share of the company's stocks. There's 2 types of price to earning ratio, the trailing PE ratio and the forward PE ratio. When you see and hear the generic price to earning ratio, that's referring to the trailing PE. To calculate the price to earning ratio, you need to divide the current stock price by the earnings per share from the last 12 months. The earnings per share is the company's net income divided by the number of shares outstanding. It tells us for 1 share of stock, how much net income did the company earn. Check out this video for a detailed explanation on earnings per share. On the other hand, the forward PE ratio divides the stock price by the projected earnings per share for the next year. The price to earnings ratio is good for analyzing whether an index or ETF is overvalued, but it's not enough information to compare or analyze whether a stock is overvalued. I'll explain why at the end of this video. Let's run through an example of how to calculate the price to earnings ratios. But before I do that, I made a 4-step guide on how to evaluate and find stocks that has a durable competitive advantage for long-term investing purposes. Also, if you haven't subscribed yet, hit the subscribe button and the bell so you'll be notified every time I post a new video about investing. Let's look at Costco on finviz.com. So Costco has a price to earning ratio of 35.77. So you don't need to actually calculate it yourself, it's already given to you. And we get this number by taking the price of the stock, which is $380.40 right now, and we divide that by the earnings per share TTM, which is 10.64. And TTM is the trailing 12 month. The forwards price to earning ratio for Costco is showing right here, which is 33.22. And we get that number by taking the current stock price of $380.40 divided by the earning per share for the next year, which is 11.45. Now let's do a comparison. If you have 2 stocks, stock A is trading at $100 and stock B is trading at $50, which one is a better value? The answer is you can't tell just by looking at the stock price. It doesn't mean stock B is cheaper than stock A just because it is trading at a lower price. Now, if both has an earnings per share of $5, then the price to earning ratio of stock A is 20 and the price to earning ratio of stock B is 10. Now, which one is a better value? If you stop at the price to earning ratio analysis, then stock B is actually cheaper than stock A. Because for every $1 in earnings, you have to pay 20 times the amount to own stock A, while you have to pay just 10 times the amount to own stock B. However, the price to earnings ratio doesn't give us a comprehensive comparison between the 2 companies because it doesn't take the growth rate of the business into consideration. Instead, we need to look at the PEG ratio, which is where we take the price to earning ratio divided by the growth rate. Looking back at the example, if stock A has a growth rate of 10% per year, while stock B has a growth rate of only 2% per year, then the PEG ratio for A is 2, and the PEG ratio for B is 5. So when we take growth rate into consideration, stock A is actually a better value than stock B. Therefore, use PE ratios to evaluate ETF and indexes because it's made up of many companies, so there isn't a growth rate for it. Use PEG ratio to compare between individual stocks of different companies. For more videos, check out the playlist on stock investing for beginners and stock investing terminologies.